Welcome to The Explainer. I am so thrilled you're here today. We are going to look at this totally fascinating paradox of the modern age. You see, that invisible, ethereal cloud that we literally all rely on every single day, it's actually made of concrete, steel, and massive amounts of electricity. So let's dive right into this. Today, we're exploring the Q1 2026 earnings of Digital Realty, which is the world's largest cloud and carrier-neutral data center platform. We're going to unpack exactly how the sudden, massive explosion in artificial intelligence and cloud computing is driving a real-world land grab for physical data centers.
And to do that, we aren't just going to read through glossy PR spin. We are digging directly into the official Q1 2026 Form 10-Q filed with the SEC by Digital Realty. We're going to uncover exactly what happens behind the scenes when the digital cloud actually starts running out of physical space.
So here's our roadmap for today's explainer. First, driving the data center boom. Second, the Q1 2026 financial performance. Third, record-breaking leasing activity. Fourth, expanding the global footprint. And finally, raising the 2026 outlook.
Let's get right to it. Part 1, driving the data center boom.
Before we get into the heavy math here, we really need to understand the massive market opportunity sitting right in front of Digital Realty. Think about it. Every time a new generative AI model is trained or an enterprise shifts its infrastructure into the cloud, it requires servers. And those servers, well, they have to live somewhere. They live in massive, heavily powered, deeply connected buildings. And because AI requires just unprecedented amounts of computational power, the businesses building these technologies are scrambling to secure highly secure data center space faster than ever before. Digital Realty's leadership explicitly notes this, calling out a further acceleration in data center demand. The absolute key phrase to focus on here is hyperscale, AI-oriented capacity. The company isn't just passively riding some wave, they're actively pivoting their resources to build and provide the specific, power-dense environments that these massive AI deployments require just to function.
Moving on to Part 2, Q1 2026 financial performance.
Okay, so we know the demand is out there, but how does an unprecedented AI boom actually translate into cold, hard revenue? First, a quick terminology check. When you're analyzing a real estate investment trust, or REIT, looking at standard net income doesn't always give you the clearest picture, mostly because of real estate depreciation. So instead, we use core FFO, or core funds from operations. This simply strips out non-core revenue or expense streams, which gives us a much purer look at the company's true day-to-day operating profitability.
And this brilliantly illustrates exactly why the market is paying so much attention right now. Looking at the first quarter 2026, Digital Realty reported a core FFO of $2.04 per share. Compare that to $1.77 in the exact same quarter last year. That is a substantial double-digit jump year over year. It just completely proves that the surge in AI and cloud demand isn't just theoretical hype. It's generating a massive, tangible payoff for the underlying real estate.
We're seeing this exact same story reflected at the very top of the income statement too. Total revenues leaped from roughly $1.4 billion in Q1 of 2025 to over $1.6 billion in Q1 of 2026. That's a 16% top-line revenue jump. The infrastructure they've spent years building is being successfully and aggressively monetized.
But the number that really shows the sheer scale of this operation is $920 million. That's their adjusted EBITDA for just the first quarter of 2026 alone. It's a 16% increase over the same quarter last year. It perfectly highlights the absolute mountain of cash generated by their global data center platform before things like interest, taxes, and depreciation are even factored in. But what does the future look like?
Let's look at Part 3, record-breaking leasing activity.
Because in the real estate game, your current revenue is great, but your signed leases, those dictate your future. And the tech giants are currently gobbling up space at a historic pace. Just consider this staggering $1.8 billion figure. Now, this isn't their total revenue. This is their backlog. This represents annualized GAAP-based rent from leases that have been completely signed, inked, done, but haven't even commenced yet. It is just a staggering pipeline of future, guaranteed money waiting in the wings.
So the crucial point here is understanding what exactly makes up that backlog and the new bookings. In Q1 alone, they signed total bookings expected to generate $707 million in annualized base rent. Within that massive number, they secured the largest hyperscale lease in company history and hit records in smaller-scale interconnection leasing. And because demand is so incredibly high and space is so limited, they possess massive pricing power.
This is evidenced by a 5.0% cash increase in rental rates just on lease renewals. Businesses are effectively locking in long-term, expensive contracts because they simply cannot afford to be left without capacity.
So where exactly is all this activity happening? Breaking down the new Q1 bookings geographically, the Americas absolutely dominate the board, accounting for $320.9 million. Asia Pacific and EMEA follow with roughly $45 and $37 million respectively, alongside $18.6 million strictly from interconnection. This regional breakdown directly mirrors where the heaviest, most urgent AI model training and hyperscale deployments are currently clustered.
All right, on to part 4, expanding the global footprint.
But what happens when your existing buildings are entirely spoken for? In the digital age, you might think code and algorithms are the most vital resources out there. But for a data center provider, the ultimate currencies are raw land and access to massive power grids. To meet this unrelenting cloud demand, they have to build infrastructure far ahead of time. And that means aggressively acquiring massive new parcels of land and prime connectivity hubs.
And their Q1 shopping spree was truly global. Let's take a rapid tour. Down in Atlanta, they bought 873 acres for $95 million. Why? Because it's expected to support over 1 gigawatt of IT capacity. That is a mind-bending amount of power. In Portland, they secured a 30-acre site to support 160 megawatts. Over in Europe, they acquired Telepoint, the leading connectivity hub in Sofia, Bulgaria, along with 90 acres near vital subsea routes in Milan, Italy. And in Malaysia, they're scooping up Telco Hub 1 and starting a new 15-megawatt development in Cyberjaya. They're meticulously placing these massive concrete chess pieces all over the globe.
Which brings us to our final section, Part 5, Raising the 2026 Outlook. When you have a quarter featuring historic leasing and strategic land grabs, well, your old predictions quickly become obsolete. The momentum from the first quarter is so exceptionally strong that Digital Realty's management really had no choice but to officially upgrade their forecasts for the entire year. They're essentially telling the market that the AI data center boom is not just some brief spike, it is a sustained, accelerating trend that is fundamentally elevating their financial baseline.
They raised their core FFO per share guidance to a range of $8 to $8.10. They bumped up their total revenue expectations to a midpoint of roughly $6.7 billion. But the most telling metric here is actually at the very bottom, development CapEx, or capital expenditures. They raised their spending outlook to a massive $3.5 to $4 billion. Why does this matter? Well, you don't spend up to $4 billion on construction unless you have an absolute avalanche of customer demand banging on your door for space that doesn't even exist yet.
Which leaves us with this final fascinating question to ponder. We spend so much time marveling at the software, right? The generative AI, the cloud algorithms, the seamless apps on our phones. But as these technologies demand exponentially more power and cooling, they become entirely dependent on real-world real estate. So is it possible that the most valuable commodity in the ethereal cloud isn't code at all, but rather heavily powered physical land? Thank you so much for learning with me today on The Explainer. I hope this really helped you grasp exactly how the digital world is reshaping the physical one.